All right. I welcome you to this session wherein we are going to discuss about IFRS 18 presentation and disclosure in financial statements. In past, there were two ISEs named as IS 11 construction contracts and IS 18 revenue recognition. They both were replaced by IFRS 15 revenue from contract with customers. In past, for leases accounting, there was IS 17 leases, but replaced by IFRS 16 leases. IS 39 accounting for financial instrument replaced by IFRS 9. And in the same manner, in 2024, IS 1 presentation of financial statements is replaced by IFRS 18 presentation and disclosure of financial statements. The objective for such changes, such replacements is only to enhance the comparability, clarity, transparency of the financial statements. So this is how IFRS 18 introduced with the objective and it replaced IS 1, and IFRS 18 replaced IS 1 with the objective that it will enhance the comparability, clarity, and transparency of the financial performance reporting. So that's all about the background of IFRS 18, which is introduced by International Accounting Standard Board in April 24, to be exact, 9th April 2024, and it replaced IS 1. And IS 1 objective was to tell about the format of the financial statement. Now, the financial statements, for example, income statement, the balance sheet, changes in equity, cash flow statement, all these, the format for all these set of accounts is now to be followed according to the guidance of IFRS 18, that is presentation and disclosure in financial statements. And the major change of this IFRS 18 is on the income statement, also termed as statement of profit or loss. I repeat, if anyone asks you that what's the major impact, that's where's the major change of IFRS 18. So that major change is on the statement of profit or loss, also termed as income statement, the statement of profit or loss, SPL. IFRS 18 requires a company to prepare statement of profit or loss, and the elements are to be reported in these 5 categories. These are operating category, investing category, financing category, income taxes category, and the discontinued operations category. By the way, you will never seen these headings in the SPL. These headings will not be shown in the SPL, but the elements will be shown according to these categories. At times, a student says that now the income statement format is same like cash flow statement, wherein we have 3 headings: the operating activity, investing activity, and the financing activity. The thing is wrong. This thing is wrong. SPL format is not like cash flow format, because in cash flow format we use the terms, we mention these terms on the face of the cash flow statement. We write the operating activity, we mention the other heading as investing activity, and the third heading as financing activity. However, in the SPL, in the statement of profit or loss, these headings will never be shown on the face of the income statement. Although the elements of the statement of profit or loss will be shown according to these categories, right? So what are these categories for which the elements of the income statement are to be shown in these categories? I repeat, there are 5 categories in the statement of profit or loss. Number 1 is operating. Number 2 is investing. Number 3 is financing. Number 4, income taxes category. And number 5 is the discontinued operations category. So what exactly are these categories and how it will impact the statement of profit or loss? 5 categories impact will be, as a result of the issue of IFRS 18, the SPL will most likely be more detailed and include additional line items which were not there according to the previous format of IS 1. Now, IFRS 18 has introduced 5 categories operating, investing, financing, income taxes, and discontinued operations, and due to which the SPL will most likely be more detailed and will be included the more line items. Let's discuss one by one about all these 5 categories of the in the SPL. First one is operating, thereafter investing and financing and income taxes and the discontinued operations. Let me show you a simple format for SPL. You can see none of these headings are used in the SPL. None of these headings are being used while preparing the statement of profit or loss. You can see nowhere we have operating, nowhere we have investing. Although the elements pertaining to these are reported, element to these investing are reported, financing, income taxes, and the discontinued operations. You will not see any of these headings in the statement of profit or loss. Although the elements will be categorized according to these 5 categories in the SPL. Hope this thing is clear. What exactly are these categories? For operating activity, it is mentioned that it's a residual category, means anything which is not fit in any of these 4 activities, any element which is not covered in these 4 categories, that is to be reported in the operating category, because that's a residual category. Means if any element is not there in investing category, not in financing category, not pertaining to income taxes category, and the 5th one discontinued operations, so that will be covered, that will be reported under operating category. That's the residual category. And what could be the investing category elements? What things, what income and expenses are to be reported under the investing categories? Any income and expense pertaining to the investments of a business. Any income, and because we are talking about SPL, statement of profit or loss, in a statement of profit or loss we talk about income and expenses. So in this heading we are not going to write the assets. In this heading we are not going to report the assets, because assets are part and parcel of balance sheet, whereas we are talking about SPL. In the statement of profit or loss, any income and expense pertaining to the investing activities, that income and expense will be covered over here. For example, if you have invested in an associated company, so that investment in associate is an asset for you, but any share of profit you will be getting, that income will be reported in this category as investing category. Number 2, if you have invested somewhere in loan notes, for surely you will get the interest income. So that interest income which you are getting from investment in loan notes, that investment is an asset, and asset is part of balance sheet. That asset will be reported in the balance sheet, but the income which you have received, which you have earned by investing in that asset, so that income is majorly pertaining to an investment. So any income and expenses pertaining to investments, they will be reported in the SPL in the heading of investing category. If you have invested somewhere in shares, so on shares you will get dividend. So investment in shares is an investment. So any income and expense pertaining to that investment is a part and parcel of the investing category in the SPL. There are transaction costs when any items which are fair value through P&L items, when they are issued, then at that time legal costs, transaction costs may arise. So that investment asset, that investment category thing, and related transaction costs, the related associated transaction costs or the legal costs, that will be reported in the investment in investing category under SPL. For example, if you have fair value through P&L items and any fair value changes, fair value gain or fair value loss pertaining to that investment, any increase or decrease in the value, that fair value gain or loss is to be reported in the SPL in the category of investing, right? At times what we do is that we dispose financial asset at fair value through P&L. So any gain or loss on that disposal of financial asset, any gain or loss, any income or expense will, because that asset was your investment and now you are disposing that investment, so for surely you will get loss or gain. So that gain or loss is to be reported to investing category. A business, for example, for a supermarket, the core business activity is to sell the goods, right? But for example, a supermarket, if have invested in an investment property, so that's an asset. At time of investing in investment property, maybe any transaction cost that will be reported over here, any the objective of investment property is to earn rental and for price appreciation according to IS 40. So if any rental income is earned on this investment, so that income and any related expense will be reported over here. And now let's say if you are if IS 40 says under fair value model of IS 40, any fair value changes, investment property is to be measured at fair value at each reporting date, and any fair value changes are reported to P&L. So in P&L, where could be these increase or decrease, these changes in value will be reported. Then these changes will be reported, the fair value changes for investment properties, they will be reported under this heading, under this category, that is investing category, because investment property is your investment. According to related IS 40 treatment, you have to check the fair value of the investment property at each reporting date, and any increase or decrease in property's value, that is to be taken to P&L. But in P&L, where it is to be reported? It is reported over here, because this increase or decrease in the value is pertaining to an investment. So any income and expense pertaining to any investment, that will be reported under investing category of the SPL. For example, as you have invested, as you have purchased an investment property with the intention of price appreciation, and now let's say you are going to dispose that investment property, you would be having gain or loss. So that gain or loss is also to be reported under this category of investing, right? So we can conclude that under investing category, any income and expense pertaining to the investments of the business, they will be reported under investing category in the statement of profit or loss. Now, what next is here? The third category, the financing category, any income and expense pertaining to the recognized liabilities. For example, you are going to issue the loan notes, and at time of issuing the loan notes, for example, preference shares, redeemable preference shares. So at time of issuing these loan notes and redeemable preference shares, there could be legal cost, there could be transaction cost. So that transaction cost which pertains to raising the finance for the business, so that legal or transaction cost is to be taken to the financing category in the statement of profit or loss. And thereafter, for example, you have to pay the interest income, also termed as the finance cost, because as you have raised the finance for the business, you have issued the loan notes, you have issued the redeemable preference shares. On one hand, you raise the finance, but on other hand, you have to pay yearly interest. So that interest which the company has paid, or which is calculated on an accrual basis, that interest is to be, which is only involving the raising of finance, these loan notes and or bank loan or redeemable preference shares just issued for raising funds, and on these things, on these elements, finance cost is to be paid, and these finance costs calculated, which is only involving in the raising of finance, that is to be considered as an expense, and this expense is pertaining to the financing category in the statement of profit or loss. The third one is gain or loss on transaction not involving the raising of finance. Not involving the raising of finance, but still the finance cost is to be taken under the financing category. What could be the example of this thing? For example, leases. You acquire an asset on lease, and there is an interest rate implicit in the lease. So now you have not raised the finance in terms of cash. You have acquired an asset on lease, and in lease there is finance cost involved. So that finance cost is also to be taken to the financing category of the SPL. Another example for the last item, for example, we always record the present value of dismantling cost. Dismantling cost is any cost which is to be incurred in future time period, but we always record the dismantling cost at present value, but we unwind the discount. We calculate yearly interest and we take the present value to future value by unwinding the discount. So that unwinding element, that interest expense, is to be considered over here in the category that expense is to be reported. So any income and expense and any gain or loss which are pertaining to the financing things for the businesses, so any income and expense pertaining to the financing activities, they will be reported, that income and expense will be reported in the financing category in the statement of profit or loss. Thereafter, any taxes calculated according to the guidance of IS 12, they are to be reported separately in the as category of the income taxes, and any assets and discontinued operations as per the IFRS 5 guidance. So that according to the IFRS 5 guidance, if there are any discontinued operations, that is to be reported separately according to a category named as discontinued operations category. So till now what we have discussed is that once IFRS 18 introduced, the objective The major change was with respect to SPL, and now the statement of profit or loss is to be prepared considering 5 different categories. And if anything which is not fitted there in all these 4 categories, so that is to be considered as the operating category. So the operating category is a residual category, means if any element which is not pertaining to investing, any element which is any income and expense which is not pertaining to financing, any element which is not pertaining to income taxes, any element which is not pertaining to discontinued operations, so that will for surely be linked with the operating category. For example, as we over here we discussed that if a supermarket has invested somewhere in an investment property, so that's not the normal course of that supermarket, because the major core business operations of the supermarket are to sell the goods, right? So if they have invested somewhere in investing property, so any related costs, income and expenses, rental income or the transaction cost, fair value changes, they will be taken to the investing category. But as the core business operations for a supermarket is to sell the inventory, so any revenue costs, any associated thing with the ordinary course of business, they are to be considered as the operating category. And the operating category is a residual category. If any element is not there related to these 4 categories, then for surely that element has link with operating category, that's a residual category. Now we are done, we are fully done with discussing all these 5 categories. And from now onwards, whenever you will be making the income statement, then for preparing the income statement, you must keep this thing in mind, that there are 5 categories, and all of these line items are to be mentioned in the SPL according to their related category. And as I also guided you that nowhere in the SPL you will see these headings. I also showed you a format. In this SPL format, in this income statement format, nowhere you can see the operating, the financing, these categories. However, whereas these categories by name are there in the statement of cash flow, so that there is a major difference in the format of the cash flow statement and the income statement. That in cash flow statement you do write operating, investing and financing category, but in SPL you will not be writing any name of these 5 categories, right? But the element will be mentioned in the SPL according to these categories, right? So till now what we have discussed is that IFRS 18 tells us about the 5 categories which are now the part and parcel of the statement of profit or loss. Thereafter, another thing, other important changes to SPL. In the statement of profit or loss, there are other changes as well which are pertaining to our FR exam. IFRS 18 tells that there are 3 mandatory subtotals in the SPL. These 3 subtotals, read these names: operating profit, profit before financing and income taxes, and the third one is profit, also termed as, that's the profit for the year. Profit is also termed as profit for the year. These are the mandatory subtotals, means these are to be mentioned separately. These subtotals must be bold. These are to be presented separately, and these are mandatory subtotals, right? Number 1, number 2, number 3. Let me open a format. Number 1 is operating profit. Number 2, profit before in financing and income taxes. And number 3 could be profit for this amount or this amount. If in any question, if there are continued or discontinued operations, then we will be continuing. We shall be calculating this amount as profit from continuing operations, and the profit or losses from discontinued operations will be shown separately. And finally, the profit element will be calculated. And for this profit, we can say that that's a profit for the year. Let me guide you one more thing. We can stop till here if there are no discontinued operations. If there are discontinued operations, then we have to continue, and then we have to take the impact of the discontinued operations as well. And the final amount will be the profit, which could be the profit for the year. So what we can do is that we can stop our P&L till here if there are no discontinued operations. And if there are discontinued operations, then that will be the last point for SPL, right? Okay. So that's the reason I have mentioned it by 3. So there are 3 main subtotals and there are 5 categories. Categories names are not to be shown in the SPL, whereas these 3 mandatory subtotals must be there. A company must make subtotal for operating profit, profit before financing and income taxes, and profit which could be termed as profit for the year. So these are the mandatory subtotal. And for with respect to 1 and 2, a point is there. For the 1 and 2, note that for 1 and 2, note that both 1 and 2 will be presented even if they are of same amount. For example, in this format, operating profit is 795 and the profit before financing and income taxes is 813. Both these are different amounts and we have showed separately. Even if these are same amounts, if these are same amount, still we have to present these two line items separately. So that's according to this point. Note that 1 and 2 will be presented even if they are same amount. Even if these are same amounts, still we shall be presenting these separately. We must be showing these two as subtotals, right? So there are three mandatory subtotals. Number one, the operating profit. Number two is a profit before financing and income taxes. And third total is profit, this amount. Or it could be, if there are discontinued operations, then the third will be this amount. Although you can see over here in this working, in this P&L, gross profit and profit before income taxes, both these are also considered as subtotal. Both these are also highlighted. Both these amounts are also in bold. But for these two, read from here, gross profit and profit before income taxes are not mandatory subtotal. However, many entities will present these additional subtotals because they are necessary for SPL to provide a useful structured summary of income and expenses. These two are not the mandatory subtotal, but the company may present these two as subtotals because it will be give you a clear and more detailed information about the company's income and expenses. However, the other three which are mentioned, these are the mandatory subtotal, and now the SPL is to be prepared according to these five categories. And let's sum up. In the SPL, what we have discussed till now, when the company would be making the statement of profit or loss according to IFRS 18, so items to be shown, all these are items pertaining to operating activity. For investing activity, for example, over here it's only one. Any of these things can be there over here for investing activities. So this thing is also important to keep in mind. Only one example is over here. For operating activity, these elements are to be considered. For investing activities, for investing category, all of these elements are to be considered. For financing activities, any income and expenses pertaining to financing are to be considered under the financing category, and from different things, only two elements are considered over here in this example, right? And income taxes are to be considered according to the guidance of the IS 12, and discontinued operations profit or loss is calculated according to the guidance of IFRS 5. So these elements are these categories. Now we have to prepare the statement of profit or loss by keeping these five categories in mind. These categories name will never be shown in the SPL, but the elements are to be presented by keeping these categories in mind. Plus, at the same time, SPL required to follow one thing is with respect to these five categories, and the other thing is with respect to these subtotals. Now both of these are to be followed while making the statement of profit or loss for any company. There must be three subtotals, which are operating profit, profit before financing and income taxes, and actual profit, the total profit. The last one, at times we also termed it as profit for the year, that is profit. These three are the mandatory subtotals, and now there are five categories in the statement of profit or loss. Thereafter, a company, if there are certain changes to other comprehensive income items, so we can make this heading as statement of other comprehensive income. The same amount of profit will be considered over here, the profit or profit for the year. That will be the starting point for preparing the other comprehensive income. And thereafter, IS 16 re-evaluation reserve thing, the IS 16's re-evaluation reserve thing is to be considered over here. And from financial instrument, if there is any increase or decrease in value for OCI items, remember we do study in financial instrument. Some financial instruments are considered are dealt at fair value through OCI. So any increase or decrease in that financial instrument value, in that financial asset value, is to be taken to the other comprehensive income. So by adding these changes to the profits, so the total comprehensive income for the year will be calculated. By adding these line items to the profit, the total comprehensive income will be calculated, right? let's move forward. As I have already guided you with respect to these 5 categories, now it's your turn to to thoroughly read all these 5 categories. So you will come to know and you will be more clear about the discussions we just have made. But majorly, once the IFRS 18 introduced, it has major impact on the SPL, statement of profit or loss. And while making the statement of profit or loss, all the elements are to be dealt according to the categories, and there are 5 categories. And while making the SPL, there are 3 mandatory subtotals. However, a company can also make the subtotal of gross profit and the profit before income taxes, but that's not necessary. There are 3 mandatory subtotals which we have highlighted and marked over here, right? And I'm requesting you to read all these, pause the recording and try to read, and please read, don't skip it for future time period. Pause the recording over here and read all these. Then we will move forward and we'll discuss about the aggregation and disaggregation concept. For presentation purposes, all of these things, the assets, liabilities, equity, income and expenses, could be shown by adding, by aggregating, and could be shown by disaggregating. And aggregating means they should be combined, and disaggregating means they are to be shown separately. And all is depends on the characteristics. What items can be aggregated? The items which have shared characteristics, they can be aggregated, and the values can be shown by adding up, by clubbing up. And if the items which do not share the characteristics, all those elements to be shown in the financial statements separately. So for presentation purposes, either assets, liabilities, equity, income or expenses, they could be shown by aggregating or by disaggregating. Aggregated means they should be combined, and disaggregated means should not be combined and should be shown separately. And all this is dependent upon the characteristics, the elements, the things which have shared characteristics, they could be combined, and the elements which do not share characteristics, they should not be combined. For example, I'm guiding you from here, and another example that will be the continuation of the first one, right? For example, if there is HR staff, human resources, IT staff, and the staff for legal and accounting purposes, all these staff members, a company would be paying salaries. But even if the staff is working in HR, even if the staff is working for IT, and even if the staff is working for accounting department, they are sharing the characteristics. They have shared characteristics. They have similar characteristics. So all of these costs, all of these expenses can be combined. The expense for HR, the expense for IT, the expense for legal and accounting, they are to be reported. They can be aggregated and they are to be reported. They can be reported in the SPL, and they can be reported as journal expenses or the admin expenses. Why? Because we are talking about staff members. No matter in which department they are working, they are the staff members. Staff salaries for all these three, for all these three departments, they are to be considered. They can be mentioned in the SPL, and we can use a single term as admin expenses. Whereas on the other hand, for example, if there is a goodwill impairment, so what do you think? Should we also include the goodwill impairment to the admin expenses? No, we cannot do that, because goodwill impairment have different characteristics as compared to these 3 examples. Goodwill impairment is of different in nature, and if it is added to the admin expenses, if the impairment of goodwill, because at times when a company acquires the other company shares, what we do is that we calculate the goodwill, and goodwill is reported separately in the balance sheet as an asset. And once there is any impairment in the goodwill, if there is any impairment loss in the goodwill, and if that impairment is material by magnitude or nature, so this must not be aggregated with the other line items. For example, it must not be added in the admin expenses. And if you do so, your material information would be obscured. So this impairment will be reported separately, and it could not be added to the other. For example, if for example in the admin expenses we may club 90 plus 10 plus 10, we may write, for example, this for IT, this for HR, this for legal and accounting. 110 could be the expense which can be considered under admin expenses. And if there is impairment of goodwill, if there is impairment of goodwill, that is to be reported separately, for example by 30. You cannot add this 30 to this 110. So you showing 140 as total and adding also the impairment loss to the admin expenses, that will not be the appropriate accounting, because goodwill impairment is something which is not sharing the characteristics with other expenses, so it must be shown separately. So same case with the assets, liabilities, equity, and all of the things, all of these five things. I just gave you an example with respect to expenses, but any of these things, if they have shared characteristics, they can be shown in aggregation. But if they do not share characteristics, so then that will be shown separately and must not be adding with the other elements in the financial statements, right? So please keep this thing in mind. And we have also discussed the concept of the aggregation and disaggregation in the statement of for the financial statements according to the guidance of IFRS 18. Moving forward, other amendments, other consequential amendments related to FR paper, as I guided you, IFRS 18 was introduced in April 2024, and to be exact, 9th April 2024, IFRS 18 was introduced. And the principles, by the way, few things which were the part and parcel of IS1, now they have moved to IS8. In IS1, there was a concept named as going concern assumption. The second is accrual basis of accounting, and these things are now have transferred from IS1 to IS8, right? Matching principle, going concern, accrual basis of accounting, these three, majorly these three: accrual basis, matching principle, and going concern, so fair presentation. So such kind of things have been transferred from IS1 to IS8, because IS1 was eliminated and replaced by IFRS 18. So now the financial statement formats are to be followed according to the guidance of IFRS 18. As IS1 is now fully eliminated, fully omitted, so the few things from IS1 have been shifted, have been transferred to IS8. So what are these? Going concern, fair presentation, matching principles. So such kind of things have been transferred from IS1 to IS8. The principles relating to going concern, matching principle, accrual basis, and fair presentation were previously found in IS1 presentation of financial statement. This content has been moved over to IS8, and the IS8 name is basis of preparation of financial statement. But that's not the very old name for IS8. IS8 name was also changed in April 2024. Once IFRS 18 replaced IS1, at that time few things from IS1 are transferred to IS8, and at that time the name of IS was also changed. Previous name of IS8 was the accounting policies, changes in accounting estimates, and errors. But now the actual name, the current name of IS1 is preparation of financial statement. When this name was changed from this term to this term, so it is also changed in April 2024, when few elements from IS1 are shifted to IS8, right? And by the way, this change is insignificant for FR paper. This change, the change in name of the IFRS IS8 from accounting policies, accounting changes in accounting estimates and errors to basis of preparation of financial statement, this change in name of IS8 has an insignificant, has an unimportant impact on the FR exam. So what we do is that we still cover IS8 according to the previous conceptual things which were there in IS8 by the name accounting policies, changes in accounting estimate and errors, plus the elements which shift, the contents which is shifted, which is transferred from IS1 to IS8, that is also now to be covered under IS8, and that's pertaining to going concern assumption, accrual, matching basis, and the fair presentation. So such things are now to be covered under IS8, and it has this, all this has not an material impact for FR exam. Moving forward, another thing, when we talk about the set of financial statement, so IFRS 18 guides us that a company must prepare an statement of financial position, simply means a balance sheet. And a company has to prepare an income statement, that is a statement of profit or loss. In simple terms, that's the income statement. A company has to make the statement of changes in equity. A company has to show the statement of cash flows, SOCF. SOCIE is a statement of changes in equity. And thereafter few things are to be mentioned in the notes. For example, if we talk about IS 10 non-adjusting event, and if the non-adjusting event is of material in nature, then the impact, a financial impact, and the detail of that event are to be disclosed in the financial statement. So few things are to be mentioned in a paragraph form. So those things are basically the notes to the financial statements, the disclosures to the financial statement, and the appropriate term is accounting policies and explanatory notes. So when a company has to prepare the financial statement, so there are these 5 elements. Number one, company has to make the balance sheet, company has to prepare the income statement, the changes in equity, the cash flow statement, and the accounting policies and the explanatory notes. Till now we have discussed the concept and the changes according to the guidance of IFRS 18. We have covered the changes for SPL. However, by the way, when IFRS 18 replaced IS1, in IS1 there was a format of balance sheet as well and a statement of changes in equity as well. All these were the part and parcel of IS1 before the introduction of IFRS 18. And once the IFRS 18 introduced, it majorly changed the format for SPL, whereas no major changes are there for statement of financial position and statement of changes in equity. And yes, there is a bit change for a statement of cash flows. Previously it is started from the amount that is PBIT. The indirect method for cash flow statement is started from the PBIT earlier, but after the introduction of IFRS 18 it is to be started from the operating profit. So apart from this, there are no major changes for these three. According to IFRS 18, the format of statement of financial position is same. The format for statement of changes in equity is not changed, is same. And to some extent, a starting point for cash flow statement is changed. Now it's started from the operating profit, not from the PBIT for the indirect method. And company has also make few points with respect to the explanatory notes for accounting policies and all that. So these are the complete set of the financial statement. Each and every company has to prepare, has to show these 5 elements in the completing the set of accounts, which are the balance sheet, income statement, changes in equity, cash flow statement, and the accounting policies and the explanatory notes. What we are going to do now, we are going to discuss about the format of the balance sheet and the statement of changes in equity. For SPL, we have already covered on the previous slides, but from now onwards, we shall be covering about these two. We shall not be covering the statement of cash flows in this lecture because statement of cash flows are to be prepared by a different IS, that is IS 7. So we shall be covering the format for statement of cash flows when we discuss the IS 7 statement of cash flows. So the related format will also to be covered in that relevant topic. However, there is format for balance sheet and the format for changes in equity. They are to be shown on the next slide. And balance sheet is prepared at a specific point in time. So that's the reason we use as at, because it is to be shown in the balance sheet. We prove the accounting equation. And what exactly is this accounting equation? For a company, assets are equal to liability and capital. So that's a basic accounting equation, and this accounting equation is to be proved for a company by making the balance sheet as at a specific point in time, and that's the year end date. So a balance sheet is to be prepared for a specific point in time for year end date. So that's the reason we use the term statement of financial position as at year end date. And in the balance sheet, we write the assets, the current assets, the non-current asset, and the sum for these two as total assets. And on other hand, we write the equity and liabilities, and we started with the equity, and thereafter the total equity, and then the liabilities are categorized into current liabilities and non-current liabilities, and the sum. If the asset sum is equal, must be equal to your total equity and liability. So this is how we show that a company's accounting equation is proved at year end. Company's assets are equal to their liabilities and equity at year end date. And thereafter, if we talk about the statement of changes in equity, during the year, company may issue shares, company may pay company may pay the dividend, company may issue the loan notes, company may issue the shares at par value or at more than par value, company earn the profits, there could be any other things. So basically, in the statement of changes in equity, what we do is that we show the yearly transaction, not for any specific time period. The statement of changes in equity is to be prepared for showing the whole year transaction. So that's the reason we use a term for the year end date. So a statement of changes in equity is not prepared for any specific date. For any specific date, there is only the balance sheet which is prepared, and wherein we show the yearly activities. So we use the term statement of changes in equity. For SPL, we also use the word statement of profit or loss for the year ended. In the same manner, a statement of changes in equity for the year ended, a statement of cash flows for the year ended. But for balance sheet, we use the term statement of financial position as at. And here is a simple format for changes in equity. There could be the headings for share capital, share premium, revaluation reserve, other equity reserves, retained earnings, and the total. Balance at year start. The previous year closing would be considered as opening year, this year opening balance. And over here, we made two adjustments if there are prior period error adjustment and if there are changes in accounting policies. IS 8 says that changes in accounting policies is to be applied retrospectively. Retrospectively means stating previous year balance. So such increase or decrease for with respect to IS 8, if there is changes in accounting policies and if there are correction of errors, that is to be made to the opening balance in the statement of changes in equity in the retained earnings, and the impact is also to be taken to total equity as well. After making this prior year adjustments according to IS 8, what we get is that we get the restated balances, and in the restated balances we have to show this year transactions. After getting the restated balances, we have to take the impact of this year transactions for the current year transaction. For example, if the company have paid the dividends, so dividend would be paid from the retained earnings, also would be reducing the total equity. If the company has issued a share capital shares, so share capital will increase, and if the shares are issued more than their par value, so there's a premium, so the differential is to be taken to share premium, and the total will also be increased. Thereafter, if the company has total comprehensive income, the retained earning, the profits are to be taken to retained earning, and if there are OCI changes, that is to be taken to revaluation reserve, and it will also be impacting the total as well. And from transfer to retained earnings, remember excess depreciation when adjusted, so it is adjusted from revaluation reserve. So revaluation reserve is debited and retained earnings are credited. So at time what we do is that we take the impact on revaluation reserve. On one hand, it is debited and retained earnings are credited, and it has no impact on the total. Only item is shifted from one heading to other heading. The amount is shifted from revaluation reserve to retained earning. So if there are such changes, so that changes are basically transferred to retained earning, and it has no impact, it has nil impact to the total, but it has impact to the revaluation reserve and the retained earning. These two headings are impacted, not the total, right? Because an amount is transferred from retained earning to from revaluation reserve to retained earning, so one would be decreasing, other one would be increasing. There will be no impact on the total equity. And after making all these adjustments for this year, for current year, balance at year end will be calculated. So this is how a company prepare the SPL as we discussed previously. And thereafter, we discuss the format for balance sheet, and we also discuss the format for changes in equity. Cash flow format will be discussed in IS 7. And by the way, for SPL, you can see statement of profit or loss and other comprehensive income. And the other heading is you can prepare the statement of profit or loss and other comprehensive income, or a statement of profit or loss plus a separate statement showing the comprehensive income. So let me show you from this format. For example, we have followed over here the second one, statement of profit or loss and separately showing the other comprehensive income. So what we have done is that for in previous format, we followed this second one. Although both are the possible ways to present the statement of profit or loss, but over here we have followed the second one. How we can say that? Because we have stopped till here to profit for the year. Thereafter we mark this heading, that statement of other comprehensive income, and then we added both these amount. This profit is considered thereafter in the heading of the statement of changes in equity, and then the total comprehensive income for the year. For example, if you don't stop at this value and simple write the OCI, and then you take these amounts and then calculate the total, so that will be the first method, wherein you are not showing separately, you are not marking this heading, you are not closing your income statement till profit, and you are not marking a separate heading for OCI. If you are just continuing preparing things and just showing OCI, so that will be the first format, and both formats are acceptable, and it's not necessary to follow any of these two. Both are acceptable ways to show the profits and the other comprehensive income. And till here what we have done is that we talked about the format for all these three, and now what next is there. uh, by the way, if we talk about with respect to exam questions, for specifically for section A and B, IFRS 18 impact on section A and B question which are relevant to FR exam. FR exam, if you remember from the initial classes, when we talk about the format of the paper format, we know in section A and B there are OTQs. In section A there are 15 OTQs, and in section B there are all OTQs, objective test questions, but they are related to a scenario. There are three scenarios in section B. Scenario 1, 5 OTQs. Scenario 2, 5 OTQs. Scenario 3, 5 OTQs. And then for section B, there are OTQs but are linked with a scenario. So what's the impact of the IFRS 18 on section A and B type questions? Section A and B, they are containing the objective test questions. So impact of IFRS 18 is insignificant. Information, by the way, information in questions and the terminologies that will be now used in the questions, they are according to the IFRS 18. Now you will never see the term as net profit, because in this format there is no term which is net profit. You can see there is no net profit according to new format. We have terms gross profit, the operating profit, profit before financing and income taxes, profit before income taxes, profit from continuing operations, and profit from discontinuing operations. Now these terms will be used, so we must give an attention that what terms are used for in the section A and B type questions. Care should be taken. For example, if any question on the statement of cash flows, or more generally on the format of financial statement, both are impacted by IFRS 18 as discussed above. New terminologies, new terms which are now being used under IFRS 18, so those also be used in the questions which are there in section A and B. The interpretation of the financial statement is also examined in section A and B. Yes, there could be questions which are asked for interpretations in section A and B. However, we will discuss the impact on the ratios while we will discuss about the impact of this IFRS for section C. There at that time we will also discuss the impact of IFRS 18 on the interpretation questions which are also examined in section A and B, and there is also a question is also examined in section C of the FR paper. So we got the same heading, IFRS 18 impact on section C type question which are relevant to FR. So let's talk about section C, IFRS 18 impact on section C relevant to FR exam. In section C there are two questions and both are the compulsory question. One question is for preparing the financial statement. This financial statement could be the final account, means the financial statement for a single company, or the financial statement for a group company. So maybe a single company question is asked, maybe a group of companies question is asked, maybe final account question, maybe consolidated question. And second question will always be for the interpretations of financial statement. That interpretation, that ratio calculation may be for group companies or maybe for individual companies. So there are two questions and both are compulsory questions. Remember that in each question you will have one question on individual company and one on a non-complex group of companies. So we can say that one question will be for final accounts and one question will be for group accounts. For example, over here, if you get the final account question for a single company, if you are required to prepare the financial statement for a single company, then for interpretation you will get question for group of companies. Vice versa, if the financial statements are to be prepared for group companies, the other question will be the interpretation but for the single company. So that's the meaning of the last paragraph. Remember that in each exam you will have one question on an individual company and one on a group of companies. So if the single company accounts are to be prepared, if the question to prepare the financial statement for a single company, then interpretation question will be pertaining to group of companies. Vice versa, if the financial statement are to be prepared for a group of companies, then the interpretation question will be for individual company. So such things will be examined in section C of the paper for these two questions. Moving forward, over here we got this, that IFRS 18 has an impact on preparation of financial statement either for single company, either for group companies, and it also impacted the ratios thing. So let's discuss this 1 and 2 on the next two slides. And over here we have heading 1 and heading 2, and the same thing highlighted. We are going to discuss further on these two highlighted points. For example, if the question is asked to prepare the financial statement, you will be required to prepare a statement of financial position, a statement of profit or loss, which include the OCI as well, and the statement of changes in equity. This complete set of accounts can be examined. Examiner may ask you to prepare the financial statements, which may include the balance sheet, SPL, or the changes in equity. The statement of profit or loss has most change, as we discussed that under IFRS 18 there is a major change, major impact on the format of the income statement, and all its subtotals, and there must be three subtotals as we have already discussed. Remember to follow any guidance to prepare or we have also covered the concept of aggregation and disaggregation as well, and all of these points, I'm hoping that you will read these thoroughly, because I have already discussed all these things in my lecture. There are minimal changes in the statement of financial position and the statement of changes in equity, but still all these will be prepared according to the guidance of IFRS 18, as we have already discussed the concepts of the format for balance sheet and the changes in equity. So all these to be prepared, and this has minimal impact, means there is no as such no impact once IFRS 18 introduced and replaced IS1. So there are no asset changes for balance sheet and the changes in equity. You may also be required to prepare the cash flow statement for individual company using the indirect method. Earlier, both the methods, the direct method and the indirect method, were the part and parcel of FR course. But now the cash flow statement for individual companies, not for group companies. So keep remember, cash flow question will always be asked for a single company and only using the indirect method. Direct method is now eliminated. We shall be preparing the cash flow statement always by using the indirect method. And for extract for the cash flow statement, you must remember the indirect method is now starts with the operating profit and not from the profit before income taxes. Before the introduction of IFRS 18, when we start preparing the cash flow statement, we start from here, profit before income taxes. But as now the income statement format has been changed, the statement of profit or loss has been changed, so that's also impacting the format of the cash flow. Now the indirect method of the cash flow statement, it starts with a operating profit and not the profit before income taxes. So this thing is also important, and we shall also be covering this thing in the statement of cash flows as well. Under IS 7 it's also covered. Also, you must remember that dividend paid and interest are presented in the financing activities, because shares issued or the loan notes issued, both are issued for raising the funds. For raising the finance, you issued both these things, and any returns which are paid on these two, they are to be considered as financing activities in the cash flow statement and not in any other activity, right? And with respect to the impact on the section C questions, which are now, if the question is asked about for interpretation, so what will be the impact? By the way, as a different terms have been used as compared to earlier in previous IS1 format, in the income statement we had net profit. So we can calculate net profit margin, gross profit margin, but you can see there is no net profit in this in the current format. So picking the relevant amount, that's what important for once you follow the IFRS 18. So picking the right amount according to correct heading, so that's what important for us while dealing with the interpretations questions. When interpreting financial statement, it is important to recognize the information is presented in IFRS 18 format. Be careful when selecting the line items in the calculation of ratios. All these are given as few examples, so you may read, but let me guide you. When calculating the return on capital employed and interest cover, the numerator is a profit before financing and income taxes. Previously, this was referred to as profit before interest and tax. Now there is no PBIT. This has been replaced by profit before finance and income taxes. So now we have to use this term. We have to use this value as rather we must not be using the PBIT. Be careful not to confuse with the profit before income tax, which have been same initialism. And when calculating the asset turnover, you may use operating profit margin in your calculation if operating profit is equal to profit before financing and income taxes. In effect, there is no involvement, there is no investment income. And if the investment income is there, if you using capital employed dividing it by operating profit margin, that will give the incorrect answer if a question includes an investment income. So we must carefully pick the relevant amount according to the given situation for calculating the ratios. Similarly, when calculating the return on capital employed and interest cover, the use of operating profit is not appropriate where there is an interest income, investment income, and both the operating profit and the profit before financing income taxes will be presented even if they are of same amount. We have already discussed this point. IFRS 18 says if operating profit and profit before finance and income tax, even if they are same amount, still they are to be shown as different subtotals. So by the way, only as the terms of IFRS 18, different terminologies are now being used under IFRS 18. So we must also give an attention for picking the correct value for calculating the ratios. So till now what we have discussed is that we completely discuss IFRS 18 and its related impact on the majorly on the statement of profit or loss. And now a statement of profit or loss is to be prepared by taking the elements into 5 categories, which are operating, investing, financing, income taxes, and discontinued operations. And there are 3 subtotals. So these are the major 2 things which are to be incorporated in the SPL. However, there are as such no changes for the format of the balance sheet and the changes in equity. And IS7 format is covered separately under IS7. So this is how we have discussed about IFRS 18 in detail. See you and take care, please.